Booyah, we are live. Why were the kids crying already so early in the morning?
She wanted she wanted to wear the new shoes that we got her, which are these very sparkly unicorn shoes, because she's a big unicorn girl. She's actually turning 4 at the end of the month. We're doing her unicorn birthday party. If you spend even 3 minutes with her, you'll get invited, assuming you don't say something to offend her.
I don't know. I have a hard time not offending people.
Yeah, just don't ask her to dance or anything. We'll be okay. And then you get to come to a unicorn party. All right, cool. Welcome to episode 70. Wow, we made it. Of Talk Your Chart. I'm Marco Segrera here with Brett Horowitz. Brett, how we doing? Today is August 5th. You're recording from the office because you're a disciplined man. I am recording from Key West because I had father guilt that I wasn't going to at least be somewhat present on the beginning of a island-like vacation, so I came down and I'm working from Key West for a couple of days. So bear with the connection.
You said that if anybody could tell what hotel you were in, you'd give them $1,000. Is that right?
Oh yeah, easy. Absolutely. If you can tell what hotel I am in, that would be horribly impressive. I'm not even going to flip my camera around because who knows what that's going to do to the connection. I'd even give you more clues. There's a window in front of me.
And a beach probably nearby.
Good luck. If you can get it, listener, 1,000 TYC dollars headed your way, whatever that means. Brett, first chart. It's a pretty one from Visual Capitalist. The last 3 years that talk about energy reliance and dependency with reshoring. That's kind of where it started with COVID, I guess 5 years ago. And then with this AI boom, I think it's just become, if it was a secret to anybody, it's no longer a secret. In 2024, China generated more electricity than the US, the European Union, and India combined. That's a lot more energy than us if the future is AI based. And apparently it is. If you follow the largest corporations and folks on the planet, we need more energy production. So all I can say looking at this chart is I hope more energy production comes online in the form of clean, green energy, absolutely wonderful. We have to lean into our superpower, which is liquefied natural gas. I'm not sure if you have any thoughts on this, but man, that was just a shocking red line. China over the US, the EU, and India.
Yeah, I mean, to go from they were in 2000 to where they are today, that's pretty impressive. I mean, that's a pretty steep line there. I assume they're doing that just because they need it, right? I don't think they have a way to sell a lot of that, right? I mean, if they're making more than they need, can you export that? I really don't know how any of this works, but it seems like they just need that because of all the people and all the systems that are requiring it, right?
Well, yeah, what they say is they need it for industrial production, which obviously they have a lot more of than we do. Our primary use of electricity is residential. Again, I don't know much about this whatsoever, other than we definitely need more capacity to make the next kilowatt hour as close to $0 of cost as possible. But anyways, I just thought this was shocking. Again, not to make this the whole political thing, but it's pretty clear that as soon as these folks walked into the World Trade Organization, a la around the year 2000, that's when you get this ridiculous upswing in production capacity that came online. But in any event, energy is a big deal. That's the real currency. Hopefully we get more online, and I don't think liquefied natural gas should be the enemy here.
But couldn't we also do the opposite? Couldn't we also try to make things with less energy so you don't need as much energy going forward?
Yeah, I think both things are happening. I think
Yeah.
both things are happening, right? Like if you look at the GPT that came out in around my birthday of 2022, 23, excuse me, that requires less energy now to do one of the computations. The problem is you're just doing more and more computations. So the single computation is taking less incremental energy, but we're doing more of them.
Okay. Well, there's smarter people than us trying to figure out this
Oh,
solution.
thank the good Lord. On to not being able to buy a house.
Yeah, so we know that this has been an issue for several years now with interest rates coming down, people kind of getting stuck in their house, not wanting to leave. A couple of things that I was surprised about before I get to the chart, some stats. According to a bank rate survey, only 3% of homeowners said they'd be comfortable selling their home in 2025, given that mortgage rates are higher than 6%. I was also surprised to learn that two-thirds of mortgages in the US now have a rate below 4%. And then existing home sales hit their slowest pace in over 3 decades. And so what this chart shows, which I haven't ever seen it in this fashion before, is the difference between the 30-year mortgage rate and what somebody's outstanding rate is. So in other words, the higher the red, it means that people have a lower rate than what's current. And the more that's blue, homeowners are going to refinance because they have a higher rate than what's current.
Got it.
And so, other than the periods from the 80s where we had this high inflation, high rates, we're to a point now where it doesn't pay for a lot of people to move, and so you're seeing that it's coming down. The article was saying it's not every state's having this problem, but this is why it's an issue of people not wanting to move, and we know this, and I don't know what it's going to take other than rates coming down for this to flip.
The U.S. existing home median sale price is around 435,000. So just affordability is terrible because you have these home prices that are up, which is great as far as the wealth effect goes, because that's a big part of folks' balance sheets. But yeah, it's going to be a combination of prices stabilizing and coming down a bit and rates coming down. I don't know.
Well, I think we've all gotten spoiled, right? You look at the 40 years where you had the blue part of the graph where somebody could refinance and get a cheaper rate. It was a long time where you just got used to that. And now
Well, if you chart the 10-year on this is just the 30, 40-year bull market in bonds that everyone talks about,
yeah, for sure.
right? Like that's what that is. Yeah. So directionally speaking, everyone should be happy about what's to come, meaning the next move in the next 1% move in rate should be down, not up. The only problem is just because the Fed fund rate moved down doesn't mean that your 30-year treasury, your
Right.
30-year mortgage comes down,
Right.
because it doesn't mean your 10-year. You just get a
Yep.
steepening curve, which is not necessarily good.
Means less on money markets. That's what it means.
Yeah, exactly. This means you get less income on your cash. Exactly correct. So we'll see what happens. I think, and I have the chart here to talk about employment down at the end, but I think the Fed may actually cut this year, I thought they weren't going to.
Seems more and more likely. I think the bad news on Friday made it more likely it's going to happen. But let's talk about jobs. We each have a chart here about jobs. So we'll start with the first one. We obviously had some bad jobs data on Friday. 73,000 jobs were created in the month of July. And in addition, May's job report was revised from 144,000 down to 19. June from 147,000 down to 14. Awful numbers. So what this chart is showing is, I think, a dichotomy between people that have jobs and people that want jobs. We had talked about before how much compensation growth you could get if you switched jobs before, right? People were leaving one job, going to another, making 50 grand more constantly, like this and like that. And so you can see the job switcher line, the gray line at the top, that started to come down, where an overall job stayer, that's coming down as well, but they're coming down to the same level, which is probably a good sign that you just simply can't leave a job and make a ton more money. There are a lot of people that are unemployed for at least 27 weeks. It's the highest number we've had in the last 8 years. So that's a negative if you're looking for a job. The positive is that with 4.2% unemployment rate, if you have a job, you're not likely to lose your job, unless you're maybe in a government position or a technology position. So I see lots of sort of different things happening depending on where you stand in this equation.
Yeah, the 3-month moving average of job creation is 35,000, which is no bueno. You said it. Friday, we learned the U.S. employers created just 73,000 jobs in July. So after May and June, that means our 3-month moving average is 35,000. So in a labor market comprising of 160 million folks, that means we're growing at 0.02% per month, which is no bueno. And then this is Nick called us from Data Trek. Friday's job report, with below consensus July reading and very large May and June revisions, reflects a U.S. economy closer to a tipping point than markets or the Fed previously thought. And this is probably true simply because job creation is arguably the most important indicator of economic growth. That's what keeps folks spending. And if you look at spending, if you look at real final sales to private domestic purchasers, or if you look at personal consumption expenditures, all trending down. So you remember when inflation was a real problem and we wanted everything to cool? That was 2 years ago and everything is still cooling. So I think at a certain point, cooling turns into a freeze, and you'd hope that the Fed doesn't do what they did on the opposite side. They took too long to hike, and now they're going to take too long to cut. And is it becoming more political than necessary? Are they blaming the potential inflation uptick from tariffs a little bit too strongly? So let's see, my friend. Let's see.
There are a lot of people freezing right now. So of the 1.8 million people that are been job hunting for at least 27 months, that represents a quarter of all the people that are unemployed. So there's a lot of people that have been searching for a long time. There was a Wall Street Journal article, I think it was yesterday, of someone putting in over 500 job applications in the last year trying to find something and only getting a couple interviews. Like, it's tough if you don't have one. So if you have one, you no longer can make the change to something else, and even if you could find something, it's hard to find that. So I would stick with what you have, be happy with what you have, and just wait till things improve.
Good nice public service announcement. I thank you. And I did my chart with your chart. My chart's got a pretty red line that's definitely going southeast there. Man,
Yeah, that is.
35,000 jobs, not good enough. I have no children in my life that are looking for jobs right now. I just got one going to college.
I mean, there's a lot of randomness into when you get hired and what the job market's like. In a
Yeah,
few months, it could completely turn. Who knows?
yeah, we'll see. The SAM indicator said we were in a recession 3 months ago. Maybe it wasn't that wrong.
Don't use the R word.
Dollar. You got a dollar chart, man. Tell me.
So interesting to see here, going back from January 25 to the end of basically the end of July, you see this reduction in the US dollar. I think most people see this, and there's two ways to look at it, the positive and the negative side. On the one side, if you are traveling from the US going overseas, it's more expensive. On the other side, there's a lot of multinational companies that are making a lot of money by having their imports cheaper. In fact, 40% of the revenue from the S&P 500 comes from overseas. So that should help. We know that Donald Trump wants to see a weaker dollar as well. But the question is, what's this going to mean long term? Is it going to continue to happen? Are people going to start not carrying dollars, not investing in dollars? They're going to ramp up their gold purchases? Is there going to be another currency that takes over? It's a short-term window, so it doesn't tell a lot about the next 30 years. But it could be very important if it continues.
Yeah, I think it's the reserve currency conversation. That's a decades long problem, and I think stuff that's coming out right now that has to do with the Genius Act and stable coins and things of that nature are going to actually provide demand for U.S. Treasuries that didn't exist before. If you saw the auction, I think it was last week or the week before, the Treasury auction. That again, every Treasury auction that no one's ever heard of in their entire life is now always the most important thing because people are kind of looking for signals. I think it's just one of these symptoms of just there's too much information all the time and people are looking for stuff to throw on their Twitter feed or their Talk Your Chart videos. There's no current competitor for the US dollar. It's the euro.
Right.
That's number two. It's the euro.
Yeah, while the debt of the U.S. is higher, while deficits are higher, you can see articles that talk about the doom of the U.S. dollar. I think this gentleman at Morgan Stanley, or Wells Fargo, says it best. She says, "We believe the U.S. dollar benefits from deep-seated advantages such as the rule of law, transparency, and a highly liquid financial market that makes a global shift away from the dollar an extremely difficult and slow-moving process, especially because of underlying weakness of most dollar alternatives." I mean, that to me says it all, right? I mean, it might happen over time, but it's not going to happen tomorrow.
You should have that tattooed on your chest. That's my vote.
I already do.
Good. All right, stay tuned for episode 71 where Brett shows off his chest tattoo. BH, last chart, man. I haven't seen this one like this. I've seen the percentage of the S&P that's invested in the top 10. I haven't seen this one, which is a ratio of the 5 biggest stocks compared to all of the small stocks. And I'm just going to say one thing on this. I sent an article out through our blog and all that stuff earlier this year that said, it was late last year, excuse me, that said you should probably own more than the S&P 500. And then we have a year where international stocks are up 20-ish% and the US is up way less than that. It was down for a period of time also. And this is one where I look at and I say, you should probably also own not just really big stocks too. Listener out there, for whatever it's worth, maybe look under the hood. Maybe don't only own the biggest stocks on the planet.
Well, yeah, I mean, if you're looking back over the last few years, you would not come to that conclusion. But I think we all know that these things cannot go up in perpetuity. We're very happy that the S&P 500 owns the big stocks and the little stocks because the big stocks have been killing it and continue to kill it. But um, there'll be a time when they won't be big anymore.
Yeah, stuff cyclical. That's all. Take for that what you will, my dear listener.
I hope we're making better investors out of our viewers and listeners.
Yeah, I hope we're making them less bad investors. I agree. Brett Horowitz, I'm gonna go have some key lime pie.
Okay, don't be drinking before noon.
No, I can't. Before 1:30. Yeah,
Got it.
key
Okay.
lime pie.
See you when you get back.
Thank you for your service. See you.
Bye bye.